All right, guys, we're going to get started here in a few minutes. I'm going to give a couple minutes longer to let everybody get logged in. I already see several of you on here, so great to see some familiar names. We've got Craig here. We've got a lot to cover today, so I want to give our time over to Craig and also want to leave enough time for questions. So give us just a couple minutes to let everybody else get logged in, and we'll get started here in just a minute or so.
Great, thanks, Heather.
All right, I think we've got quite a few more on. So in an effort to keep this on time, because I know, Craig, it's not quite as early where you are as where I am. So we appreciate you taking time from your family to
No,
be with us. We're
absolutely.
going to get started. If everybody could just give me a thumbs up, maybe in the chat section to let me know that they can hear us all right. I just want to make sure the audio is okay. We will get started. Also, I want to encourage you guys as we go along. We want this to be interactive. You know, I'm not here. I don't think Craig is either to just give you a presentation where you guys can't ask questions. Craig is a wealth of knowledge, and I want you guys to be able to take advantage of his expertise. So as we go along, if you guys have questions, we're going to do our best to address those kind of as we go and if we feel like it's relevant to the presentation. And then definitely at the end, we will give you guys the opportunity to put questions through. It looks like there's a question section as well as a chat section. I'm not sure. Let me see here. I think for those of you folks that are attending, you're going to have to put it through on the questions section for us. So I will keep an eye on that. But we're going to get going here. So if everybody's good with audio, I think we're good to get started. So I want to introduce Craig. Craig and I have, I guess we met, a little bit over a year ago through Chris. And so it's just been a real pleasure to get to know you better as well as your clients. But a little bit about Craig. Craig's a seasoned financial advisor and coach. He's been dedicated to helping individuals and families achieve financial freedom. Very impressive. Craig is a graduate of Penn State University, undergrad in finance, and the University of Virginia, master's in accounting. So quite the resume there. Craig started his career working in private wealth management at Goldman Sachs, where he spent 10 years advising high net worth individuals. Craig started investing in real estate back in 2017, and subsequently left corporate America to work with Chris Miles, Money Ripples. Some of you folks that are on here as attendees are very familiar with Chris and his program and his podcast. And in 2020, he joined Chris and Money Ripples, and he's coached over 100 clients and educated and taught them how to build passive cash flow and achieve financial freedom. And, you know, I can attest, I've got the pleasure of working with a lot of your clients, Craig, and I must say they come to us with a lot of knowledge. And I think I actually mentioned this to you the other day. It was the first time in my over 20-year history that I had one of your clients give me a questionnaire to fill out before he got on the phone with me. And I was like, oh my gosh, this is really impressive. So kudos to you and Chris. You guys are doing a great job educating your clients. But Craig's also an avid tennis player and pickleball player. He resides in Tampa, Florida with his wife, Amy, since 2017. So I forgot to ask you about pickleball. We've got our investor summit coming up. For those of you that are actually on the webinar today, if you are in the area, we have a great event coming up April 9th through the 11th, complimentary of Central Lending. And we're bringing people in office to present to you like Craig and Chris, some self-directed IRA custodians, but we are having an opportunity to play pickleball, Craig. So if
I
you're
can't
so
wait.
inclined, you'll probably
Cannot
whoop
wait.
everybody.
You knew you could have so much fun with a wiffle ball, that's for sure.
I know, I know. My brother-in-law is a collegiate college tennis coach, and I'm like, what do you think about pickleball? He's like, oh no, I don't have that long. So anyways, we're excited to have you here again. You know, I appreciate you taking time from your family. I know it's much later where you're at, but I just, you know, I really resonate with what Craig is teaching their students. And, you know, for all of you that are on here, I recognize a lot of names. I know that alternative assets is the buzz right now. You know, people just in the last 5 years, even just in the last 2 years, have become so much more involved with making decisions on where their investment dollars are going. And I think with all the noise out there and the webinars and the podcast, I always find a ton of value in aligning myself with people like you and Chris, Craig, because you guys talk the talk, you're educating people, and it's just been a pleasure. I think the way that you guys look at these investments as well as the way that I do, even though I'm not a financial advisor, I'm not going to give advice on portfolios. I think that's where you guys can fill a void. And I've seen your guys' clients over the years accomplish so much financial freedom that I thought that having you on would just bring a ton of value to people that maybe currently aren't working with you, that might want to explore that option and just kind of hear what you kind of have to say about alternative assets in people's portfolios. So I'm not going to waste any more time. I want to get to the meats and potatoes of what Craig has to present. I'm going to hand over the ability to share your presentation. And like I said, everybody, as we go along, if you have some questions, make sure you're putting them in there. I actually see some people have put a couple things in already. Hey, Chad, great to see you. Chad says go Penn. So
All
you've got
right.
some sympathy there.
Love
And
chat
Chad
already.
says he's in PA right now. So glad to have you, Chad. All right, I'm going to hand this over to you. And like I said, we want this to be interactive. So we encourage you guys to definitely interact with us. And hopefully we can bring some value to you guys tonight. So I'm going to make you the presenter.
Great. Thanks, Heather. Appreciate that introduction.
I'm I'm not the technology person. You can ask Kate, who works
Perfect.
in my office.
We'll go with this. I think we'll be able to
Okay.
get the gist of it. Can you see the Meet Your Advisor slide now?
Yep. You're good.
Great. Excellent. Well, I appreciate that intro, Heather. Definitely, the feeling is mutual. We love working with you and your team, especially on the cash flow side. I think, for everyone that's on the call that is a client of Central Lendings, you guys are lucky to work with Heather. Really, really, you're a superstar, and we appreciate all that you do. Um, some quick background on me before we kind of get into the meat and potatoes of alternative asset investing. As Heather mentioned, I currently live in Tampa, Florida with my wife. Love living here. I'm a big outdoors guy. Love tennis, love pickleball, as Heather said. Play a lot on the weekends. I am a former Wall Street investment banker and private banker. I worked at Goldman Sachs for about 10 years. So really kind of cut my teeth, learning about the stock market, right? Serving high net worth clients. And obviously, I learned a ton, really learned what it's like to be a professional, right? Learned a lot about investing. But through my work there, I had some really bellwether moments. I started working in 2007, right? So for anyone on the call who was able to survive the great financial crash, right? So that's right when I started my career, and so I got some quick education on how quickly the stock market can turn against you, right? So I was kind of when I was in college learning about the markets, kind of that mid 2000s, saw a good bull run there, and then saw everything crash down, in 2007, 2008. Obviously we've had, a pretty nice bull run since then. The markets are volatile now. But I really had some light bulb moments saying, okay, I'm managing assets for these high net worth people. They're worth 10 million, 20 million liquid. That's great for them. And I can see, I can build a portfolio to help them retire, to help them reach their goals. But what am I going to do, right? Am I going to sit in my seat, making a good salary, investing in my 401k, hope I get to a few million dollars if the stock market allows me? And then am I just rolling the dice, right? And hoping that's enough for me to retire. And so it's kind of right around that time frame I was introduced to the CEO of Money Ripples, Chris Miles. He was a mentor for me. I joined up with Chris in about 2020 as I was leaving New York City when my wife and I were coming to Tampa. And we brand ourselves as anti-financial advisors, which we'll kind of get into what that means. But I love that lingo because we really live and breathe kind of being an anti-financial advisor. And what's our focus, right? It's achieving financial freedom by investing in passive alternative assets, right? There's a big scale of what's passive, what's active. We'll get into that in a second, but that's kind of what our mantra is. Before we get into alternatives, I think it's really important to talk about what's a traditional financial asset, right? Typical, you've got your bonds, your mutual funds, managed funds, ETFs. stocks, cash, cash equivalents, right? Money market funds. And then, what the traditional space we'll call alternative funds, right? So those are going to be kind of REITs, maybe some hedge funds, some PE investments, super illiquid, pretty risky, but still kind of under that managed fund type of model. I just put together what does a high risk or traditional portfolio look like, right? So you're going to have a mix of, primarily equities, so high growth stocks, split between U.S., international, emerging markets, very thematic type of investments. Maybe a little, some exposure to alternatives. We're seeing the crypto market kind of take off right now. Obviously, a very volatile asset, but some Bitcoin ETFs are kind of sprinkling into some of those portfolios. Maybe some REITs, maybe some gold and silver, and maybe a little exposure to fixed income, right? And so the key about or the key takeaway about this portfolio is this is kind of a set it and forget it model, right? So, if you go to your traditional financial brokerage, they're going to have different type of risk appetites, right? So you fill out a questionnaire. If you're younger, typically you're going to be more on the high growth side, and then it's kind of a plug and play type of model. And the key question here is, does it work, right? And we're going to see, Heather, over the next, I'd say, 5 to 10 years, how this model holds up because we're starting to get into, people retiring. The baby boomers are kind of,
Hmm.
hitting that retirement stride right now. The pension model, right, is really kind of, pretty much non-existent at this point. If you still have a pension, good for you. And, I'd say the first question I ask myself is the pension funded, right? What are the pension liabilities? But we're really going to see, does this 401k model really hold up, right? Because when the 401k was started, it wasn't really meant to be the sole retirement kind of vehicle for a lot of people. Obviously, we have Social Security as well. That's not really paying a whole lot. But the question is, does it work, right? And at Money Ripples, really how I coach people, we don't want to find out the answer to that question, right? We want to take control, put our retirement, our financial freedom in our own hands, and not let the stock market do what it does.
Hmm.
So, what is an alternative asset, right? We just talked about traditional. What's an alternative? If you type it into Google, what comes up is an investment that falls outside of traditional assets, stocks and bonds. Okay, like what does that mean? How we define it is an asset that has specific performance metrics, right? That you can rely on. Say a fund that pays a 12% return where the investor has some level of control, and that's going to be very asset dependent. We're going to talk about that in a second. And this is my favorite part, is where tangible value is identified, right? We always want to ask ourselves, especially on the alternative side, where is the third party value, right? If we can't identify where the value is, maybe that's not an investment that we want to align ourselves with. I think, a rental property is a great example, right? You buy a rental property, what's the tangible value? You're providing a great place for a tenant to live in. It's very easy to identify that. We like to invest in things with tangible value because we have conviction that they're going to grow and pay us cash flow.
I love that.
Really important to focus on what are the types of alternative assets. I love all of these types of alternative assets, but they're not right for every single individual given what your specific goals are. It's also kind of, if we take a step back and go back to this model here, right? This kind of plug and play traditional model. Traditional financial advisors are not asking you what are your unique specific goals, right? Are you growth focused? Are you cash flow focused? That's why when we're building portfolios, on the alternative side, you really want to ask yourself different questions. Do we want our portfolio to grow, right? Have we already, do we have a lot of assets to invest? Do we need cash flow to live on? Those are really critical questions to ask yourself before you start to invest, right? So I can't tell you, Heather, how many times I've worked with people who are looking for cash flow, but then they've invested in 3 or 4 apartment syndications that don't pay any cash flow, right? Just they don't know that those are the right questions to ask. They just kind of assume, even if the PPM says, we're going to have, we're going to target 10% distributions, right? Whenever I see a syndication, for me, the first kind of check mark is this is a growth asset. If we get some cash flow, I look at that as a bonus, right? So when we're thinking about
Yeah.
investing, we really want to look at what are the different types of asset classes and do they fit into, what my goals are, right? So, turnkey rentals, especially if we like real estate, that's a great place to start. Lending and notes, clearly, this is what central lending does. Obviously, one of the big things I love about lending is return on capital, right? Your money is in and out of assets a lot quicker than it is maybe on the syndication side. We've got funds, right? So that's kind of like think of mutual funds for the alternative asset market, right? Typically managers have fund mandates. A lot of funds will be cash flow focused, so really important to kind of make those distinctions. We're hearing a lot about small businesses right now, right? We've got what's
Yeah.
called the silver tsunami, a lot of boomers retiring. We're reading a book in Money Ripples right now called by Cody Sanchez called Main Street Millionaire, all about how to buy small businesses.
Oh,
Lots of due diligence. This is not passive. This is more of an active play, but something that still, investors are really thinking about, really interested in. And oil and gas, right? I love oil and gas as a great kind of hedge away from real estate. It can be speculative, but it can also be very conservative as well. So lots of different types of asset classes. We're going to get into kind of the details of about how to think through these, and as you kind of build your portfolio. But a really good kind of precursor to think of like, okay, I've got
yeah,
some money
that's,
to
I like
invest.
that.
What's the type before I get into, what is it I'm actually investing in,
Yeah, you're right. I get calls all the time. And a lot of times they don't even know what they're trying to accomplish, you know? And
right?
it's like you're going to give yourself, brain damage looking at all these different offerings if you don't first determine what you're trying to accomplish. And sometimes it's multiple things, right? Like it's different buckets of dollars and, things like that. But
So true. Having clarity on goals and kind of working backwards is really the key to success for sure.
yeah,
So if we start with real estate, right? I think anyone new to alternative asset investing, I recommend starting with some type of real estate. Number one is because it's easy to understand, right? But then even when we talk about real estate, there's so many different subclasses that's really important to kind of you know, talk through to say, well, what's the right type of real estate for me? So let's just quickly go over what all these mean, right? So number one is the buy and hold, right? This is your classic kind of, you're investing in your own backyard type of thing, right? So I'm in Tampa, Florida right now. I'm constantly looking at investment properties, going on the market in Tampa. I want to buy them, really make sure they're cash flow positive, just because I know the area so well. I'm so bullish on Tampa and St. Pete that I have a lot of conviction, right? This is a tough strategy for people in very high cost of real estate states. California is kind of example number one. Really difficult to buy in California into cash flow, right? We won't even go into tenant laws right now. But
yeah,
if kind of fall into that bucket, right, maybe number two is a better option, right? So that's the turnkey model. That's working with, a third party provider who finds out of state real estate on your behalf, right? Typically, they'll connect you with a property manager. Sometimes it's in-house. They kind of do the hard work for you. Obviously, some due diligence you have to do to verify numbers, but I'd say that's a really, especially for our clients, right? They've got full-time jobs. A lot of them have busy careers. Turnkey is a very passive play to own physical property. You've got your fix and flip, right? That was really popular, I'd say 3 or 4 years ago when real estate values, pre-COVID, hadn't exploded. Interest rates were low, right? So people were buying properties, fixing them up, flipping them for quick profits. Sounds easy, is not easy, takes a lot of work, is a full-time job and has some risk, right? That kind of leads us to number four, the BRRRR method, buy, rehab, rent, refinance, repeat, right? So kind of similar to the fix and flip, but you're holding onto the property, pulling out equity, using that equity to find another deal. It can work well when it does, and it can be a disaster when it doesn't, right? So I'd say three and four,
yep.
definitely more higher risk, and I'd say very, very active. And then we have funds and syndications, right? So we kind of talked about this from an asset class perspective earlier, but these are investments where real estate, right, is the underlying fundamental investment that's generating the returns. What do we like about real estate? This is the big slide right here. There are four rates of return, and it's very difficult. I don't think I know another asset class that has four rates of return, and they're all important, right? And I want to make some distinctions here because I feel like people focus on the wrong rates of return for their goals, right? Um, let's focus on number one and two for right now. Cash flow and appreciation. So a lot of times people will purchase real estate for cash flow, right? You see a pro forma. We're going to get into a pro forma here on the next slide. You see a pro forma. It cash flows $400 a month. Maybe it's $40,000 down. You're super pumped, right? Um, Novice real estate investors learn very quickly that while cash flow is critical to a real estate deal, it's very difficult to rely on cash flow, right? Especially if we're building a retirement portfolio. Because what happens? Tenants don't pay, right? We may have to evict them. Things are going to break, right? Think of your own house, right? Think of all the repairs you do. Those same things are going to be relevant to a rental property, right? So, I've had properties that have cash flowed amazing for 2 years, and then I get hit with a huge expense, right? HVAC goes down. There's a hole in the roof. So it's important, I'd say, when you're just getting started, start with one rental property, have some reserves, right? Make sure you've got some cash on the side for when those repairs or evictions have to happen. But we want to make sure that the property is cash flow positive, right? Because when you think of buying a real estate, think of it as like you're buying a business, because in essence, you kind of are, right? Would you want to buy a business that is cash flow negative, meaning your rent or your mortgage is more expensive than the rent you're bringing in? Absolutely not. So we're going to talk about why in a second. That brings us to number two, appreciation. The real wealth from real estate is made through being patient, letting properties appreciate. This is why buying in, a good location is so critical. Um, let's use, Austin, Texas, I think is a perfect example here, right? So Austin was like the boom town post COVID. Lots of people moving to Texas, lots of people, especially, from that San Francisco tech industry moving to Austin. Property values exploded. It was the number one place a lot of people were moving to. So people were trying to ride that wave, right? So they were buying property, especially on the Airbnb side, not necessarily, maybe they were break even, maybe a little bit negative. But what's happening now is property prices are crashing, right? They're down 20, 30% from all time highs. So if you bought in Austin and you're negative cash flow, now not only are you paying out of pocket every month, rents are down. And if you want to sell your property, you're probably going to have to come to closing with cash, right? Because your property is not worth as much as it was when you bought it, right? So
Yeah.
not enough time for the market to rebound. And if you were cash flow positive from day one, you could kind of ride that volatility appreciation wave, right? So I really
Yeah.
tell people, let's focus on cash flow, make sure it's positive, at least month over month, and then let's have a long-term view and let appreciation take over, right? Principal reduction, obviously another huge asset. Why we love real estate. You're not going to see a ton of principal reduction until kind of the back third of a 30-year fixed mortgage, but it still exists. And then number four, depreciation, right? I could do a whole nother session on taxes. But really, when you are a real estate investor, especially if you can qualify as a real estate professional, depreciation is your friend and can make and save you a lot of money. Really quickly, I'm not going to spend a ton of time on this slide, but this kind of goes kind of back to our example of having a cash flow positive property. This is a property I own in Cleveland, Ohio. So this is a real life example. As you can see from this sweet interest rate here at 3.5%. I don't know if we'll ever see
Wow.
investment loans like that again, right? So I am, holding on to this property for a long time, I think, right? I'm actually working on a refi on it right now because I've got some equity. But purchase price, we love the Midwest. People from California, look at these properties and they can't believe you can buy a property for 155. It's worth a lot more now, but this is back in 2021. And so on paper, I really liked how this deal looked. Um, this rent of 1250, this is also guaranteed by Eden. It's kind of Cleveland's version of Section 8. So I
Oh,
really like that as well. The rent was guaranteed. I know the tenants. I have Eden go in there once a year for an inspection, and I usually pay about 1,000 to 2,000 after that inspection when there's some repairs. I'm happy to do it to upkeep the property. But I actually just had a real estate agent. This is what I tell people: if you have rental properties, call a third party real estate agent. Say you're thinking about selling it, just so you can get a good sense of what it's worth, right? So my agent told me, this was literally last week, He said he would list this for about 225 to 235
Wow.
based on recent comps. So a really nice return over 5 years. It's one of those things you can't necessarily expect that. But I did a lot of due diligence on location. And you can see here, great cash on cash return, but not a number I can rely on every month, right? So when things are going well, I get some nice cash flow. Um, but really, until this mortgage is paid off, and not something I would really want to rely on for retirement purposes. But as you're kind of thinking about it, you want to know what's the principal and interest, what are the taxes, right? My taxes actually just went up, probably in line with property values. What's my insurance rates, and then property management, right? Critical in the turnkey side. We don't want a job. We want property managers to manage the tenants for us. Due diligence, we're going to talk about this across lots of different asset classes. And I'm happy to send this out to the group afterwards, but really critical. A lot of times people will just find a property, they like it, the numbers make sense, and they want to buy it. We're going to talk about the cons of real estate, right? And alternatives here in a couple more slides. I'd say the big problem, or it could potential problem be with alternatives, is the concept of liquidity, right? When you sign that contract, the house is yours and it's not easy to get rid of, as opposed to, if you're invested in a mutual fund or a stock, you want some capital, you hit a couple buttons in your E-Trade account, you have the cash. Not so on the alternative side. So when you're buying real estate in particular, the amount of due diligence you need to do is critical. A couple things to highlight. Obviously, set your budget, know your numbers. You need some reserves. Cash return versus neighborhood class. This is a big one. The better the cash flow, or the better your cash on cash return, typically the worse the neighborhood, right? So there's a trade-off. And the worse the neighborhood, potentially maybe not as great of an appreciation play. So I'd say really do a lot of work on where the property is located. And I'd say sometimes it's okay to sacrifice a little cash flow for a nicer property in a better neighborhood because your long-term growth potential is going to be high, right? Stay out of one-horse towns. Detroit kind of comes to mind. It's very auto heavy. I'm not saying don't invest in Detroit, but just do a lot of due diligence. If something
Yeah.
happens, say EVs, right? It looked like they were, really gaining popularity. Not sure how that's going right now. But that could, disrupt the Detroit auto market, right? So if you have property in Detroit, maybe there's not as much demand there. So we want to be in, areas that are close to big cities with a lot of industry. Obviously, check your numbers. Look at features on the home. Every property should have an inspection report. My two big deal breakers with inspection reports: foundation and water. If I see any of those on an inspection, I'm going to walk away. That to me just means too many Easter eggs, that are
Yeah.
hiding that, I don't want to be responsible for. Um, Obviously ask a lot of questions. If there's a tenant in place, look at the rent roll, make sure they're paying on time. And I'd say most importantly, be the CEO of your portfolio. This goes true for, even if you have a lot of stocks, if you own a lot of alternatives or syndications, you know, nobody cares more about your money than you do, right? Make sure that rent is collected, even if you have a property manager. If you have your mortgage on auto pay, log in once a month, make sure that it's been paid. Don't take anything for granted. Kind of going
Good
on to some other
advice.
asset classes. Um, Alternative asset funds, right? So we talked about this earlier. I love funds as well. Why do I love them? Because this is what we call mailbox money, right? Obviously central lending has some very successful funds. I'm sure a lot of people on this call are invested in some of those funds. We like getting paid monthly. We like getting paid quarterly. We like not having to worry about tenants, right? About repairs, about vacancies. I'd say with funds, the critical criteria here is who you're investing with, right? I'd say the big question whenever you're doing a fund investment is who, not what, right? Too many people will say, I want a fund that gives me exposure to self storage or to mobile home parks, right? Where the better question is, who am I investing with? Do they align with my core values? When I send them an email, do they respond? If I want to look at the books and records, will they let me? If I want to come visit, you were talking earlier, Heather, about hosting an investor day. I love that, right? You and Drew want people to learn more about central lending, right? If I was investing in with a fund and they never really talked to investors or got them together once a year, that to me maybe some red flags, right? So ask who, not what, and then make sure the investment mandate, right, is in line with what your goals are, right? So if your goals are cash flow focused, make sure that the fund pays cash, right, regularly, whether it's monthly, quarterly, because some funds will be more growth focused. And you always want to know what's the underlying asset that's generating returns, right? So many times I'll work with people and, they're invested in a fund, right? And they don't even know how it makes money, right? So what is the underlying asset that has to perform for you to get paid, right? If you invest in something, this example here, we're talking about, multifamily in the Midwest, right? Kind of class B properties. If I'm talking to this fund manager, I'm saying, how many houses or doors do you own? How many tenants are currently in default? Are you raising rents? How frequently? Those are some of the just initial questions. And if they have trouble answering them, or I feel like I'm not getting honest answers, I'm going to pass, right? So you want to make sure that your fund operators really know what they're doing and are experts in their field, and that you personally have a lot of conviction in the underlying asset that's generating capital. Here, we do have some, a lot of funds are accredited investor only. There are some non-accredited options as well, which I think is really important for people who haven't quite met that accredited investor threshold. Kind of going comparing, I love the compare and the contrast to funds and syndications because a lot of times people don't know the difference, and boy, are there differences, right? So whereas a fund is kind of, you are providing capital, the investment manager is doing whatever they do to generate money, and typically there's some type of liquidity lockup period, maybe 1 year, 2 years, 3 years. Find out what that is, and then whenever you want your capital back, you put in a redemption request and the operator sends you back a wire, right? Syndications, completely different, right? Whereas a fund um, is invested in something with a lot of underlying assets, right? So could be 100 notes, right? A syndication is one specific asset where there's a general partner, right, who's raising capital. For people like us, we are the limited partners, right, providing a lot of the capital. Typically, it's going to be, a great example is a multifamily apartment complex, right? Syndications, the primary driver here is growth, right? Um, we want to see, 1.5, 2x potential on our money because syndications have a lot of risk. Why do syndications have risk? A, it's one asset. So if something goes wrong with that asset, your capital could be at risk. And the big one a lot of people don't think about is liquidity lockup, right? So typically
Yeah.
syndications, your money is tied up for 5+ years, right? It's 2025 now. Think about what happened 5 years ago, right? We were just getting into COVID. Think of how much has changed in the macro economy from 2020 to 2025. Pretty much, the Fed
Yeah.
has turned the economy upside down. The big thing here is interest rates, right? So a lot of these syndications were financed using variable rate notes, right? We saw before I had a 30-year mortgage on that Ohio property at 3.5%. Now let's extrapolate that to say, we had financing at 3.5%, but it's on a multi-million-dollar apartment complex. When you go to refinance a multi-million-dollar loan and it was at 3.5%, and now it's at 7, you can do the math that a lot of these apartments are not going to be able to afford those payments. So that's where a lot of LPs, limited partners, ran into problems, and a lot of people lost capital, right? And the issue is your money is locked up. When something goes south, it can be difficult to get it back. So we really want, when we're thinking about our balance sheet, right, and how we invest, we really want to get a sense of what are our goals. Am I looking for cash flow? Am I looking for growth? And then we want to make sure every investment we have is varied in terms of lockup, right? So we don't want, if we have $500,000 to invest, we want to make sure that not all 500K is invested in investments where you can't touch it for 5+ years, right? I think there is, especially now, I think there is room in a portfolio for syndications. It's kind of that Warren Buffett methodology when people are fearful, be greedy, right? And when people are
Mhm.
greedy, be fearful. Well, people are fearful of multifamily right now, right? Because a lot of people
Yeah.
have gotten burned. But now you're seeing, especially if you're with the right general partner, you're seeing people being able to buy fire sale assets, right? So big apartment complexes. maybe 50% of what people bought them for in 2020. Now there's some
Wow.
potential upside, right? So now could be a time to get involved. Obviously, we'd want to see some fixed rate debt, take away some of those risks. But kind of to what we were saying earlier, the key question is who, not what, right? Go with a syndicator who's been around for 20 years. I want to see gray hair on these people. It's like a full cycle is about 5 years. I want to see somebody who's done 3 or 4 syndication deals, has been successful in all of them, and has paid out on all of them as well. So just kind of some initial due diligence. Won't spend a ton of time on this slide. This is just kind of your basic um, deal structure at a very, very high level on how people raise money for syndications. Typically, you're going to have GPs, general partners. They're the ones doing the day-to-day operations. They're raising capital. They've got, what they're going to buy the building for, their estimated renovation costs. I always want to see whenever I'm looking at syndication, first question I ask is the GP, how much of your own money is going into the deal, right? I kind of want to see proof as well. Show me the wire transfers, right? Um, if the GP doesn't have a lot of money or doesn't have any money in the deal, I absolutely would not invest. But just get really crystal clear about preferred rates of return, where you're at in the capital stack. Really, really important questions to ask. Here's just kind of a quick overview of the difference between syndications and funds. I kind of covered this on the last few slides. I'd say time horizon, right? Really, really, make sure is it 5 years, 7 years, the type of risk and the type of due diligence that's required. I'd say, true to your heart, Heather, structured lending, structured notes, one of my favorite types of asset classes for a variety of reasons. I'd say number one for cash flow, right? Obviously, you can get some great double-digit returns on your money, kind of that mailbox cash flow now type of investments that we like.
Yep.
Very easy to identify the value, right? We were talking about that earlier. So you're providing financing for somebody who's going to fix and flip a house, right? To a tenant who wants a good place to live, right? And then really, I'd say two big things here, right here. Property is collateral, right? Let's go back to the syndications, right? Where you don't have collateral. If the deal goes down, your principal could be at risk. With short-term lending, oftentimes you're going to have the property as collateral. Do we want to take ownership of this property? Of course not. But if we have to, it's there, right? It's a great insurance. We still get paid. Our dividends, our monthly checks come through the door. And I'd say, kind of going back to that liquidity example, especially if it's a one-to-one note, oftentimes your capital is going to be in and out of the deal in less than a year, right?
Yeah.
So you're not going to have those same macro effects that you will when your dollars are tied up. So lots of things to love about short-term lending. I think as interest rates remain high-ish, right? I think we're going to see rates in the 6 and 7s here for a little while, maybe a little bit of relief there. But I think lending is going to become more and more popular.
Hmm.
Um, as investors search for yield, search for cash flow, and critical question to ask, especially obviously, talking, with you, Heather, what's the default rate when we're looking at your funds? Obviously, your default rate's super low. I know your funds very well, and it's because you guys are such conservative underwriters, right? Which I love. I would take a lower return to have conservative underwriting than higher returns where the manager of the funds don't have the same underwriting, criteria, as somebody like you guys do. So super critical to ask those questions. Really important slide here to talk about, the difference between all these asset classes. Um, look, we keep kind of going back to this theme of what are your goals, but really when you're investing, think about what do I want? Do I want cash flow? Do I want growth? And then back into what type of investment is going to check that box for you, right? If you're looking just to kind of dip your toe into the water, you don't want a lot of your capital at risk, and you really like real estate, maybe the turnkey method is for you, right? Lots of pros to having a turnkey property. One thing we also didn't really discuss is you have insurance on your property, right? If you have a mortgage, the lender requires insurance. If you've got a duplex in Oklahoma and a tornado blows it over, the insurance company is going to write you a check, right? So that's some really good principal protection right there. If you want cash flow, right? If you're a busy professional and you can't deal with the property manager, you don't want to go through, the what it's like to get a mortgage. It's a pain in the butt, right? To deal with all these lender requests. Maybe a fund is the right model for you, right? You just want some cash flow to come through the door that you don't have to worry about. If growth or taxes are critical, right? Maybe a syndication is the right deal. So kind of ask those questions. What are you looking for? And then back into what is the right type of alternative investment. These are some due diligence questions that I love going through. Really just kind of high level, but asking people, how long have you been in business for, right? I kind of use 2008 as my own personal benchmark. Not that the fund or the firm has been around since 2008, but the people that I'm investing with, I want to have been in business before then. Obviously, just it's so important to have balance sheet risk management, right? Making sure that there's enough cash and liquidity on a balance sheet to go through different stress tests, right? And not that I'm saying don't invest with people who are younger, just do more due diligence, right? When you're asking those questions, obviously we want to know, how does the underlying investment make money? What are the risks, right? I love, have you ever not paid? And if so, what happened? How do I get my principal money back? I think is critical. A lot of people will fund an investment, don't realize that it's locked up, that maybe they can't access it for a couple years. So make sure you ask and get the right answer that meets your goals. Is
Yeah.
there going to be growth to the deal, right? And taxes, right? Maybe we could talk about taxes on another call, but are there tax benefits? Really, really critical, especially for high income earners. Kind of the key question, right? We talk about the plug and play portfolio allocation of the traditional investments. How much should be invested into alternative assets, right? And why, I'd say getting really real with your money and your goals is so critical is because there's no one size fits all asset allocation. Of the 100+ people that I've had the pleasure of working with, not one portfolio is the same, right? Everyone's portfolio is different based off of their goals. So I'd say, ask yourself, the first question is cash flow or growth, right? You can have both, but your portfolio most likely is going to be weighted towards one side or the other. I'd say most common if you're younger, if you still have a lot of years to work, focus on growth, right? Especially if you're on the fund side, choose compounding over cash flow. A lot of fund operators will offer that. And as you kind of ease into your retirement years, you want to take a step back from working, flipping the switch to more cash flow investments is typically going to be in your best interest. And a good place to start, right, is to say, what are your monthly fixed costs? And I define a fixed cost as a bill you have to pay, right? If you don't pay a fixed cost, somebody's going to be knocking at your door, right? So that's going to be your mortgage, your car payments, any insurances that you have to pay. Kind of get down to your bare bones fixed cost. Say maybe it's $3,000 a month, $5,000 a month, right? And if you can design a cash flow portfolio to meet that minimum, that's a great, I'd say, first target for a lot of people to work towards. Because even if you love your job, right, and you love the stock market, you want to stay invested, kind of having your fixed costs covered every month takes a lot of anxiety and pressure off of your day-to-day life, right? I worked in corporate America for a number of years at a bank. I've had amazing bosses and I've had some nightmare bosses. And I can tell you what, things can shift on a dime, right?
Yeah.
And so I'd say getting your fixed costs covered through alternative assets is typically where I like to start because it gives you flexibility, it gives you options, and it puts you in control. I'd say critical to start small and be diversified, right? Just because you have $500,000 to invest, $250,000 to invest, does not mean you have to put it all to work, right? Or I'll work with people who have been lifelong stock investors. And I say you don't need to liquidate your portfolio, right? You can start with one $25,000 investment, one
Yeah.
$50,000 investment, right? Get proof of concept, educate yourself, really learn about the core values of the investment operator you're aligning with. And that kind of brings me to the next point, which is education, education, education. You should spend a lot of time learning about how this operator makes money, how they view risk, and what are the controls they put in place to mitigate those risks, right? You don't need to be an expert in the space because we all have jobs, right? Who has time for that? But you need to be conversational. I always tell people, if you're married, do not invest unless both spouses can talk about the fund at a high level. How does it make money? What are the risks? Do we like the operators, right? Anyone who, has any sense of being able to live, right, can answer those questions. It doesn't take a PhD to be able to talk about these investments. And it's a good check, right? If you are confused and you go, Craig, I've been studying this investment for 2 days. I really don't know how the heck they make money, and I'm not sure how they mitigate risks. Do not invest, right?
Yeah.
That is something you should not align yourself with. I said here, meet the general partners. Obviously, you and Drew and the rest of the team are hosting everybody. I love that, right? Take the time, do the extra due diligence, book a flight to Lakeland, and meet the team, right? It'll really put things at ease and give you a lot more confidence um, to not only make your first investment, but continue to grow a portion of your portfolio with those specific operators. And I've touched on this in the past. Be the CEO of your investment portfolio. I've got everything in Excel. We've got a cool investor portfolio as well at Money Ripples. I check it daily, right? Even though it's passive income, you nobody cares more about your money than you do. I love that phrase because
Yeah,
it's
I like
true.
that.
Um, and if I've got I'm pretty anal with this stuff, but with all my investment properties, I have a specific bank account for each property. And the reason I do that is because I don't want to commingle rents, right? If there's an issue and I'm not getting paid 1 month, I need to be able to identify it immediately and solve that issue, right? It's some people think that's overkill, and it might be in certain cases, but really do what's best for you.
That's good advice.
It really is, just being organized, especially come tax time. Oh my gosh, you'll be happy. Your CPA will be happy
Yeah.
if you can kind of send over bank statements and docs without kind of having to sort through a lot of stuff. We talk a lot about the alternatives market. I still have a lot of money in the stock market. I view it more as, I don't want to say fun money because it's not fun when the stock market goes down, but really kind of more as not money I'm relying on. I still want to see my portfolio grow. I love just analyzing companies. Great example for me is Tesla. I've been a Tesla bull for a long time. And if you Google Tesla stock year to date, you're going to know I'm not super happy right now because there's a lot of things that happened out of my control, right? That I had no say so over, and now my investment in Tesla is down a lot, right? So that's okay because I knew the risks of getting into it. But I'll say, when we're looking at the stock market, the concept of liquidity is critical, right? When you have alts, make sure you have a lot of cash reserves on
Yeah.
hand. Have a nice 6 month, 9 month, 12-month emergency fund that you literally do not touch. This kind of commingles with infinite banking, right? That's my colleague and partner Chris Miles really, that's one of his specialties is IBC. That's a presentation for another day. I know Chris has spoken to you guys as well. That's a great way to diversify some cash. But really just be aware of what the pros are for each investment, what the risks are, and when you look at your balance sheet, make sure your investments are aligned with your goals. I love this quick example of stock market versus a debt fund, right? This is a real life client example, right? How $100,000 appreciates over time. And so if you see, in a simple IRA, right, client has about 6 years, so they're able to access these funds. They're contributing about 20 grand a year, which is the simple max. They have 100K for the specific investment to put to work. If we look at historical stock market returns, about 8.49%, compare that to the 14% that this person can get with this fund, you can see over 6 years, the delta between the two numbers, right? It's
Wow.
almost $100,000. This also assumes that the market doesn't go down, right? So if the market tanks like it did in 2008, it's going to take a lot more than 8.49% to get back to even. Obviously, the stock market has been on a bull run really for a number of years, which has been great for stock investors. Kind of circling back to my point earlier, is we just don't know what's going to happen, right? Versus more on the alternative side, as long as the fund is performing, right? And it takes a lot of due diligence to make sure you're aligning yourself with operators that perform and have consistency, but we can do more predicting, right? We can be confident that If, their business is performing, we're going to get 14%, right? That's a compounded number. And then here's the real kicker is when we actually take the draw, right? So we use 4%. That's, who knows if that rule is outdated, right? There's lots of Monte Carlo simulation analysis that proves, hey, the 4% rule, you're never going to run out of money. I don't want to bank on models, right? I like to bank more on the research I've done, aligning myself with the right operators. But if you look at the 4% rule versus, the same fund will pay a 12% annual return,
Hmm.
look at the difference in cash flow month over month of what you can live on, right? So it
That's
can be
crazy.
a crazy difference if you look long term, right? But again, do your due diligence, spend some time on education, and make the best decision for you and your family. Just kind of, an overview. What do we do at Money Ripples? Um, I'd say the core pillars of our program, and I'd say, really critical for everyone on this call to make sure they're in alignment on all these strategies. Personal financial statements. You should have an updated balance sheet and an updated monthly P&L, right? The income you bring in from your job versus your expenses. Hopefully that number is cash flow positive. If it's not, we're going to have to do some work to make sure it is positive month over month. Look at debt strategies. This is both if you have credit card debt or if you're utilizing your assets, right? If you want to take out a HELOC, you want to do a cash out refi. I'll tell you what, I've seen debt play out on both the stock market side using what's called an SBL, right? A securities based line of credit versus a HELOC. The securities based line of credit, right, is a line on an investment portfolio, and man, if the market tanks, you will get a margin call. The custodian will sell assets to meet that call without you even asking for it, right? So it can be very risky. Versus a HELOC on a house, houses are not valued by a third party. When you have your HELOC, it is what it is. If you use it wisely, it can be a great wealth building tool.
Yeah.
We talk a lot about education, right? Can't emphasize that enough on the investment side as well as infinite banking. Building your financial team, right? This is critical. If you're the CEO, um, obviously you want to be aligned right with your investments, but you can't forget about the rest of your financial planning, right? Being with the right CPA, right? Focusing on tax efficiency, um, trust and estate planning, insurance, asset protection. Really need to make sure all of those boxes are checked, and then implementing your financial roadmap, right? What does that look like? How many years? Going based off of what we think we can get from working with certain investment operators. How long is it going to take to hit your numbers? And then mindset, critical, right? What do I mean by mindset, right? A lot of people talk about be abundant. What does that mean? Really, from a Money Ripple's perspective, it's about being a good steward of your money, right? There's people are kind of in two camps, savers and spenders, and one is not better than the other. Neither is bad or good, right? A lot of people say, "Oh, is it good that I'm a saver and bad that I'm a spender?" I would say no. Being a saver can be scarcity focused. Being a spender, sometimes maybe that's irresponsible. We like what's called being a steward. It means you're providing value, right? In exchange for that value, you're earning money. What you do with that money is critical, right? You need to invest it wisely, but you also need to live your life, right? I hate budgets. Spend money, spend it aggressively on things that really bring you and your family a lot of joy and a lot of happiness, right? If you love to travel, go to Europe, right? If
Yeah.
you love classic cars, figure out your budget, save for it, and then, buy a car that you're going to love driving.
I love it.
So there's not a right or wrong answer here. Just make sure your mindset is that of a steward and that of a giver and a provider, and you'll be set.
I
Really,
love
what
it.
can you do now? What can you do now? I know we're kind of running up on time, but I love
I
some
know
action
I should have
items.
set this longer. I didn't realize I'm feeling like you gave such
Now we
great
can, we can
content.
go
We
over
could,
we can go over too. Yeah, I'm happy to stay on if
well,
there's
I think
questions.
it actually
Absolutely.
shuts off, like with GoToWebinar, it shuts us down at an hour. But I'm going to let you
Well,
wrap it up.
let's take a couple minutes, just for some questions to it. If people have them, we'll go quickly. But here are just some good tips, right, of things you can do right now to improve your financial situation. I'm happy to send these to you, Heather, if you want to, post them
I would love that.
to the group later. We can certainly do that. And then, here's my contact info. If you want to get a hold of me, I just love talking about investing. I love talking about alternatives, the stock market. I'm dipping my toe into the crypto world. I think there's something said for that too. It's speculative, but it's fun, right? Investing should be fun. A lot of people forget about that.
Yeah.
They have a lot of stress around it, but that's alternatives in a nutshell. Would love to hear any questions with the few minutes we have
No,
remaining.
you've provided great content, and I'm gonna not put my next slide up. I want to leave your information up there. If you guys are not already involved with Chris and Craig and Money Ripples, I encourage you because I've seen the way they've changed people's lives. And I think some people are scared. They're like, "Oh, I'm embarrassed. We're probably not in the place that we want to be." That's the whole purpose of getting aligned with somebody like this, right? You have to take action, and I think that's where a lot of people get really scared. And I felt that way myself. But you get to that place in life where you don't want to work forever, and you want to enjoy life with your family. So I don't think unless people take action and start getting into the real numbers and being real with themselves, that your situation's not going to change. Um,
So true. Yep. And that's to your point earlier. Never have shame around money, right?
no,
Life happens. Life is crazy for all of us. Expenses can come up. We have to take care of kids and aging parents, and
yeah,
certain financial things happen, and it's never too late to for a reset. That's for sure.
yeah. Well, I think this might shut off. We'll keep talking if it doesn't, but I want to thank you first before we do get shut down by a GoToWebinar because um, just great content. Like I can't say it enough, and there are several people on here that I know are your clients. There's also several that are not. So I would encourage all of you to reach out to Craig. I did put the link to that book you mentioned. I'm going to actually order that you guys are reading, the Main
Great.
Street Millionaire. But if you guys want more information from Craig and want to explore what Money Ripples is really about, reach out to him. Also, if you're interested in the event in April that is coming up in a couple weeks, Craig and Chris are going to personally be there. So I encourage you guys. I actually looks like they're not going to shut us down. So I am going to share my screen. If you guys want to attend the event in April, get a hold of myself. It is completely complimentary. We are going to have some amazing food. We're going to go back to the restaurant I went to with you, Craig.
Oh, it's so
To
good.
19. Oh, it was so good. We're also offering complimentary golf as well as pickleball. So it's going to be a great event, great content. It's just a way to network with other like minded individuals, professionals like Craig in the industry, and then other investors. We've got people that are actually invested with us that are attending. So if any of you guys have interest, I encourage you to get a hold of me. We still have room for you. The more the merrier. If we don't have enough room, we'll make room. And then again, get a hold of Craig if you want to explore that. Let's see if there's any quick questions. It looks like there might be one. Uh, Kate asked, does Craig have recommendations for parents to start with kids from an investment
Yes.
perspective? We'd love to hear
Abs
something on that.
Absolutely. And I think I'm glad you brought this up, Kate, because what, we touch a lot of our clients about is, think of the knowledge that you're learning, right? And the cash flow that you're building. If you can get your kids started, when they're in their late teens, early 20s, I just turned 40 over the summer. By the time they're my age, they will never worry about money, right? That is true. I think
Yeah.
a great place to get started is with a rental, right? Especially when you're younger. The house hack, man, I wish that strategy was around for me when I was 22. Buying a house, renting out rooms, right, or getting a duplex, living on one side, renting out the other. You can do that with an FHA loan at 3.5%, right? Holding on to that property, getting another one. What a great place to start building wealth. Sometimes parents can act as co-signers, co-borrowers, so it can help with the financing, and a great place to allow kids to take some ownership. What I love too is college towns investing, right?
Yeah.
Lots of things to think about with college towns, namely, the house is going to get beat up a little bit, so have that expectation. But you're going to have renters pretty much every year. COVID be darned. If things are normal, there will be renters in that house, and parents act as co-signers for rent, right? So oftentimes rent's guaranteed. Um, if you have a kid in college, something to think about. As alternative asset investors, we love thinking outside the box, and that's a great way to get started.
That's great advice. We actually got into the rental business, my husband and I, when our kids started going to college. And so we started house hacking, knowing that they needed somewhere to live. They also played sports, so they had all these teammates that were looking for places to live. We were going to have to pay for them to live somewhere anyways. And so we had them get in, rehab the houses, and educate them about it. And I mean, to your point, like, I wish I knew 30 years ago what I know now. Like,
Right?
it wasn't
I
out there.
know.
People thought if you were going to get a loan, you went to your bank and your banker gave you a loan, which is still the case, but there's also other options out there with private money if you're more of an active real estate investor. And
Yep.
people just were taught that if you were investing your dollars, you funded your 401k, maybe you had a pension and you went to your financial advisor, and that's just, those were the options. And so it's so powerful that there's this type of education out there, and I think it's, changing lives. So great recommendation for children. Another question somebody had is, can you elaborate a little bit on self-directed IRAs? There's a lot of
Yeah.
buzz out there about that.
Yeah. So the self-directed IRA should be more popular than it is. Um, Check out Matthew Calhoun from Equity Trust. He's amazing. Has been a great
He's
partner.
speaking at the event in
He is.
Lakeland.
Yeah.
Yep.
So think of a self-directed IRA as very similar to a traditional IRA, but it allows you to invest in alternative assets, right? So if you have an IRA at, say, Vanguard, right, you can only invest in paper assets, right? So stocks that you can buy on an exchange, bonds, mutual funds. If you wanted to buy a rental property inside and you called your Vanguard rep, they're going to laugh at you and say that's not possible. All right. So what you can do instead is open a corresponding self-directed IRA, right? They could be a traditional, it could be a Roth, it could be a simple. You could shift funds, right, to non-taxable event. Just make sure the account type is the same. So if you have a traditional IRA, you need a traditional self-directed account. You can shift cash from the traditional to the self-directed, and then you can use that to invest with Heather and her team in the central lending funds. You can purchase investment real estate. There's some nuances there. You need some more money down. I can obviously, speak offline and get into the details there. But basically, it allows you to invest in cash flow assets using your retirement funds. The rules still apply, right? I can't touch the money tax-free, penalty-free till you're 59 and a half. But I've seen a lot of people, especially if you've been a great 401k investor, if you're
Hmm.
still with the current job, it can be tough to move 401k assets until you retire. That's the only nuance there. But if you have an IRA, very easy to open a corresponding self-directed, fund it, and then you're off to the cash flow races.
Yeah, they're pretty powerful. You also have the ability, if you qualify, to open a Roth or roll over a
Hmm.
Roth as well, which is even, we could talk about that for another hour.
We
But
love we love Roth money, that's for sure.
yeah, we do. I would say 90% of our clients are using some kind of a self-directed account.
Hmm.
And this is a way for you guys as investors to, invest in a tax deferred or and sometimes in a tax-free environment if you're using a Roth. So they're pretty powerful. Any of you young people, if you don't have a Roth IRA, go open one.
That's right.
Tell them all that, to include my kids. Okay, let's see. Any other questions? We've still got a few people hanging on here. Let me give it one quick second. I do want to thank you again. I know your time's valuable, and I just I know how valuable the education is that you guys teach. So I really appreciate you taking time out of your schedule to be with us. For those of you that are on this, we did record this, so we will send out a replay. By all means, share it with your friends and family. There's no obligation. We're just passionate about educating you. So we'll get that probably sent out here in the next day or two. And it sounds like Craig has some tools also that he offered to supply us with if you guys want any of those. So feel free to put those requests in, and appreciate your time and looking forward to seeing you in a couple weeks in person.
Yeah, thank you so much for the invite, Heather.
Yeah,
This is awesome.
absolutely.
Chris and I
Yeah,
appreciate you, Drew, and the Central London team so much.
it goes both ways. It's a very mutual beneficial relationship. So we appreciate you guys as
Absolutely.
well.
And hope
All
to see
right. It
everybody
does.
in April.
Yeah, yeah. Don't forget, you guys. If you guys want to attend in April, get a hold of me, and I will definitely get you on the list. So everybody, have a good night till next time, and thanks again, Craig.
Thanks so much, Heather. Talk
All
soon,
right,
guys.
take care. Bye.